HIM's stock is down about 20% after they announced the recent quarter earnings. Currently, the stock is trading about $41. So is this a buying opportunity? This is what we're going to cover in this video. Now, we've done a video on HIM's business model in the past, so we will not be repeating most of those details in this video. So if you want to learn more about HIM's, please watch that video. We will leave the link in the comments below. Let's now go over the recent quarter earnings. As you can see on the screen, they did beat both the revenue target as well as EPS estimates. Let me now show you another snip that shows the 2024 numbers in greater detail. So they made the revenue of $1.47 billion, up 69% year over year in 2024. Subscribers grew to 2.2 million, up 45% year over year in 2024. Gross margin was 79% for the year end of 2024 compared to 82% for the year end of 2023. Net cash provided by operating activities was $251 million for the year end of 2024 compared to $73 million for the year end of 2023. Now, with reference to the 2025 guidance, the revenue will be in a range of $2.3 to $2.4 billion. And this is about 59% revenue growth at the midpoint. Now, HIM stated the following. Our expectation is that weight loss offerings such as our oral solutions, liraglutide and personalized semaglutide will contribute at least $725 million of revenue in 2025. Adjusted EBITDA will be in a range of $270 million to $320 million, reflecting an adjusted EBITDA margin of 12 to 13%. So the question is HIM's a buy at $41 stock price? Now, before we go over this, we want to clarify that this is not financial advice. We're not qualified to give financial advice. We're simply recording our thoughts on HIM's. It takes a lot of time and effort to make these videos, so please consider liking this video and subscribing to the channel. So at $41 stock price, the market cap is about $10 billion. We do know that the revenue growth is amazing, but it is all about the margins. If this tremendous revenue growth is associated with very low margins, then this is not attractive. So I will talk about two cases. In case number one, I will assume HIM's will make $5 billion of revenue by 2029. If the current adjusted EBITDA of 12 to 13% still continues till 2029, then their net profit margin will be at 5% or less. This will give a rise to $250 million net income. If I apply a 40 multiple, then HIM's would be worth about $10 billion. Now, currently, they are at $10 billion. So this represents zero gain in 5 years, assuming no dilution. But HIM's does dilute shareholders year over year. So if I consider dilution, then the stock will have negative returns from the current price of $40 for next 5 years. And this is obviously really bad. If you believe that HIM's will have a high churn rate and cannot get the adjusted EBITDA moving up from 13%, then this is the case. Now I will talk about case two. I will assume HIM's adjusted EBITDA of 12 to 13% will improve to 25% by 2029. And this can only happen if they will not experience a high churn rate once they turn down the marketing spend. If this is the belief, then I can assume 15% net profit margin, with which HIM's will have close to $750 million of net income. I will give it a multiple of 50 as I think investors won't pay any more even at that time. This will make HIM's a $45 billion company. Even when I consider dilution, the stock should still be well above $150, which represents a 3x or more return. Now, I personally do not have the evidence for or against the two cases that I just mentioned. HIM's does not reveal the churn rate, and so I cannot say if there is a high rate or a low rate. Because of this uncertainty, I will continue to stay away from HIM's. Let me know your thoughts in the comments, and thank you so much for watching.